I'm Matt Bichard with NAREIT.com here in Phoenix, Arizona for REITWise 2015, NAREIT's Law, Accounting, and Finance Conference. Joining me is Adam Cohen, Executive Director Tax with WP Carey. Adam, thanks so much for joining us.
Oh, you're welcome.
Now here at REITWise, you moderated a session on REIT tax issues. What do you see as the biggest challenge that REIT tax directors face today?
I think the challenge we see today for the most part is a resource constraint issue. There's a lot of demands placed on the tax department, and we're becoming more and more integrated with the accounting and finance functions, but we don't have enough people. And I think one of the other big challenges is facing qualified and trained people. I think that the tax function was traditionally around tax return preparation and some accounting, and I think more accounting skills, financial disclosure, and operational skills around REITs, around real estate, and tax reporting in general is required.
Now, what are the most critical steps a REIT must take in managing built-in gains?
Well, once you have your built-in gains, you have built-in gains. And now the question becomes managing when you dispose of those assets with built-in gains. If those built-in gains have the 1374 taint, as many people are familiar with, we did have some periods of relief with a 5-year holding period instead of a 10-year holding period. That created an opportunity for some REITs to dispose of some of those long-held assets, well, within 5 years, but it would be more than 5 and less than 10, without triggering the 1374 tax. If you just have built-in gains that aren't subject to the tax, then it's a matter of whether or not you'd have to make additional distributions to your shareholders to meet the 90% distribution rule. I think the process involves the tax department being connected with the strategic planning or business groups within the company, making sure there's a pipeline and keeping a schedule of any 1374 built-in gains. With respect to the rest of the portfolio, it's understanding what the dispositions are and having good tax basis records and understanding that pipeline so that you're not caught off guard towards the end of the year.
And lastly, can you talk a little bit about the internal controls in the tax function?
How much time do we have? Nothing's really changed. What's happened is that regulatory PCAOB, et cetera, they've come down hard on the auditors as to spend more time getting a better understanding of what's actually happening in the tax department. So it's not that we really want to change what we do, but better document what we do. The things that come natural to us may not be natural from a documentation or a regulator standpoint, because if you're not there, they don't know that you did it. So it's no longer adequate to just simply sign off on something by putting your initials on it. The auditors want to know, what is it that you actually looked at? Did you match pre-tax book income in your provision to what's actually in your provision? How did you know that it didn't change, an entry got booked? Those are the kinds of little steps that they want to get into to making sure that your key controls are actually working and that you're doing the procedures you say you're doing, and that they understand you've walked through the process and you've met the technical requirements. No different for the REIT tests. REIT tests, they want to understand, how did you get from GAAP, what they've audited, to what you're actually reporting as your REIT tests. Those types of proof provide assurance and support the work that you've done, so that if there's ever an inquiry or scrutiny of your procedures or your controls, you've got the documentation that says, I didn't just sign off on this, I actually know that it's reasonably correct and free from a misstatement.
Great. Adam, thank you so much for joining us.
You're welcome. Thank you for having me.
Great. For more on this and other REIT news and analysis, be sure to visit REIT.com.